think I'm a pretty rational person. What do you think? Are you a rational person? Well, according to Frederick Nitzsche, in everything, one thing is impossible: rationality. So we need to explore that in behavioral finance this entire month on the Retirement Answer Man show. Welcome to the show. I'm so glad that you're here. Now, this is the show dedicated to helping you not just survive retirement. We truly believe that you can rock retirement, maybe by being a little bit more rational and being a little bit more intentional about making decisions about life, retirement planning, investing, and money. And so we're going to explore that this week. We're going to explore our humanness and how do we not try to become Spock, but how do we embrace our humanness and focus it on making better decisions, because we can really think our ways into a lot of different traps. So to do this, why don't we define what behavioral finance is in our What's That Mean segment?
Huh? What does that mean?
So according to the CFA Institute, behavioral finance is an area of finance that attempts to understand and explain observed investor and market behaviors. Why do investors sell during bear markets and buy during market peaks? Is that rational? Why do markets have bubbles or bear markets? There's a lot of things that behavioral finance tries to explain that don't necessarily make sense. And it all revolves around our humanness and this idea of making rational decisions. So that's the groundwork. Now, in our main segment, let's talk about traditional finance, behavioral finance, and why it's so important for us. So Albert Einstein said, "I never made one of my discoveries through the process of rational thinking." Isn't that interesting? He's a scientist. Isn't that supposed to be rational? My intuition says that that has to do with creativity, thinking outside the boxes. So let's think, what is traditional finance? And this is important to set up as we think about this. So traditional finance assumes investors are rational, optimizing players. So if you look at modern portfolio theory, how someone chooses their asset allocation is going to be based off of a premise that every player, investor, is going to try to maximize returns or minimize losses in their portfolio. And they're going to try to find the sweet spot that achieves those two things along the risk spectrum. In finance theory or modern portfolio theory is called the efficient frontier, which is the spot on the asset allocation matrix from 100% cash to 100% stocks that is the most efficient in optimizing return versus risk. And in theory, any portfolio that is not on that efficient frontier is inefficient, not optimized, and rational people would make that decision. So a fundamental assumption is that the players, the investors, are rational in their decision-making and they're utility maximizers, meaning that if they're going to take some risk, they want to get paid for it. They have to maximize utility based on the risk they're willing to take. And then an assumption that is incorporated in that is that, and this is the big one, that the players, meaning you, the investor, can filter information and assess the trade-offs. So when you look at finance theory, this is the assumption. You're a rational optimizer, you're risk adverse, you're a utility maximizer, and you can filter information and assess the trade-offs in order to maximize utility. And so it assumes that that's how all the players are. Now, behavioral finance looks at why people do what they do, because we don't do what traditional finance theory assumes we do, at least not on the short term. We're prone to self-deception. Social influence is a huge part of it. And we use emotional and cognitive shortcuts all day long. And we're going to dive into some of those as this month progresses. So we are semi-rational players, unlike what traditional finance theory says. And so these cognitive biases, there are things like information bias, outcome bias, money illusion, loss aversion, immediacy bias, contrast effect, on and on it goes. If you look at Wikipedia, there's just a laundry list of cognitive biases, which are essentially ninja mind tricks that we play on ourselves that can lead us down the roads of not making rational decisions in our best interest, although it feels like we are. And so we're going to explore some of those. And I don't profess to be an expert on this. My expertise, if at all, comes from the wisdom and having conversations with clients, I don't know how many over the last 25 years and navigating this journey to retirement. I'll relay just a brief one, and I may have shared this before. So here's an example. I don't know how to label of what biases these are. It's a conversation with a client. This is at the end of March, which was the low of the bear market as of then, a very brief bear market as of now. And the conversation basically went like this: Roger, this pandemic is something we've never seen before. The markets are cratering. We don't have a model for this. I think we should sell everything. Seems rational. A lot of worry, a lot of fear there. So we talk through that and we agree on a strategy to mitigate a lot of that fear and get to a solid ground. And then in the last tail end of the conversation, it flipped from we should sell everything, the world is never going to be the same. Literally, the question flipped to, now, do you think I should buy some airline stocks? Now, you may not be to that extreme, and this is an extreme example, one reason why I'm sharing it, but we all have, and I know we do, I know you do, because I do, we all have versions of this that may not be as extreme, versions of these ninja cognitive bias things that are happening almost subconsciously as we focus on making decisions like, do I retire? Do I work another year? How do I invest? I'm afraid of inflation, but I only want to hold cash. All of these things that we have to navigate. And there's tens of thousands, if not millions of decisions around retirement that we have to navigate. And all of these biases and ninja mind tricks we're playing on ourselves are constantly there. So that's what we're going to try to explore. We can't eliminate them. So let's just get that on the table. You, my friend, cannot be Spock. I cannot be Spock. So if we can't eliminate the craziness of our minds, we have to self-manage. And there are ways that we can do that. And we're going to explore some of those ways and hopefully wrap that all up at the end of the month with how do we do that. So this is why this is so important. Just finance theory and modern portfolio theory, and assuming we're all rational, it's an easy assumption to make when you're in a calculator or in an Excel spreadsheet, but it's not reality. So here's another reason why it's important. I was reading a book recently called Fix This Next by one of my favorite authors, Mike Michalowicz. It's a business book. And he was using, to explain his message, the old Maslow's hierarchy of needs. We may have all been exposed to that at some point in our academic career, but I think it goes to part of why we play these ninja mind tricks on ourselves. It's a pyramid, and you can look it up, and maybe we'll have a photo of it in 6 Shot Saturday. And at the bottom is the fundamental needs of a person, physiological needs: food, water, warmth, rest. That is the essential thing, the physiological need that a human needs to survive. And then you go through this process as a human, satisfying that. And then you need safety, security, and safety. Once you get your physiological house in order, then you need some safety and security in that. And then once you feel like you've satisfied that, now you go up the hierarchy and you go to belongingness and love needs. You need intimate relationships. You need friends. You need social structure. And once you feel like you've achieved that, so those first 2 layers, safety needs and physiological needs, are your base needs as a person. And then we start to get into the psychological needs, which are the belonging. And then once we have the belonging, we need esteem, prestige, feeling of accomplishment, purpose, so forth. Once we've accomplished that, we go to the top of the hierarchy of a human's needs, and that's self-actualization, potential, purpose, creativeness. Now, you are somewhere on that spectrum in how you think every day. If you're near retirement, you probably have your physiological needs taken care of. You have safety and security. You got your cash reserves. You got your debt paid off. You feel like you have a nest egg for retirement. All of us can be hardwired to focus on 1 or 2. Some of us are always worried about our physiological needs, even if we should be way up the hierarchy, because maybe we grew up with nothing. We saw our parents struggle. We struggled early on, and that imprinted on us that we're always going to worry about that, our physiological and our safety needs. Even if we have Jeff Bezos money or Warren Buffett money, we're always going to be hardwired there. And I have clients like that there's no real realm of possibility that they're not going to be okay physiologically and financially from a security standpoint. And they have belongingness, they have healthy relationships and friends, but they can't get beyond that from a thinking standpoint. So they're always making decisions like they have nothing. And that's okay. And then you have others that are focused all on the self-actualization, but they haven't taken care of the foundation underneath. But when we're thinking about behavioral finance, this is why this is so important. And I think we saw this play out over the last few months with this pandemic. It had, the markets were really volatile, but they're not that bad. But many people were in the self-actualization or the esteem, prestige, feeling of accomplishments, being creative. And either because of fear or actual losing their job, they went down the pyramid really quickly, down to safety. Will I be able to be housed? Will I be able to keep my house? So this pyramid, this hierarchy that Maslow has created, we think of it, okay, we've taken care of one, check it off, move up to the next one. But we move up and down this pyramid from self-actualization down to physiological needs, sometimes really, really quickly, based on what is happening in our lives, how we're imprinted on things. So if you think of it like a surfer, okay, so you watching a pro surfing contest and you see these guys riding these huge waves and they're in the self-actualization. They're being creative. They're exploring their full potential as they're riding the big wave. In a heartbeat, they can be down, thrown into the water, thrashed around by the undercurrent and be totally about, I need a breath of air. They can go from self-actualization to physiological needs in an instant. And I think that happens with us when it comes to pessimism and optimism, feeling like we're getting on our heels in life because of health, markets, pandemic, work, income, relationships. We can feel like we're on our heels, and then suddenly we can feel like we're on our toes. Things are going our way. We're getting a little bit more optimistic, and we start to move up the hierarchy again. I think this is the essence of what we need to explore this month, because we float up and down this really quickly. Where this comes into play is our brains play tricks on us. We can imprint, like we talked about, but our brain, we have this amazing brain. The human brain is really complex, and it's prone to self-deception, irrationality, and bias. Because unlike pretty much any other creature, we can imagine and create scenarios in our head, and physiologically, the emotions and the responses can feel like it's real. So especially left alone, according to research, what can happen is we can think ourselves into tangled webs that can be very difficult to unwind. Left to our own devices, it's very easy to create these. Think about, whether it's in your relationships or in markets or in your career or what somebody's thinking about you, your boss or whatever. We can create these scenarios and really, literally think our way into a corner that forces actions that may not necessarily be in our best interest or based on actual fact. That is just part of being human. It's part of what makes us special. So for us, we need to figure out, how do we process this, avoid thinking ourselves into these corners, and how can we make more reasoned decisions with very, very incomplete information and with all the cognitive biases that are in our backpack. So that's what we're going to explore this week. And next week on the show, we're going to explore our behavior in life planning and life decisions. And then we'll move on to retirement planning and investments. And then we'll wrap it up with a toolbox of sorts. And if you're in the Rock Retirement Club, we're going to have some great discussions on this. And we'll have Dr. Daniel Crosby really help us dive into this and hopefully give us some tools to be able to manage ourselves. Now, with that, we're going to move on to our question and answer session with a special guest. So today on the show, because Nicole is on maternity leave for 2 months, 2 months on maternity leave. So she's not going to be on the show for a couple months. Wish her well, say some prayers for her and her baby boy. And she's actually just about to have her baby. So we don't know the name and the weight and all that, but we'll share some of that information as she allows. But so today what we're going to do is we're going to have David Stein from the amazing podcast, Money for the Rest of Us. And great book by the same title, to answer some of your listener questions. So here we are in June, and I am without the lovely and wicked smart Nicole Mills. And I'm here with the wicked smart, but not necessarily lovely. I mean, he's got a gruffy beard, and he's, I guess, a good-looking guy as far as guys go in my. But with Mr. David Stein from Money for the Rest of Us. How you doing, buddy?
That's good. I'm doing good. This is what you look like if you've been locked down for 2.5 months.
Yes. I'm literally talking to you, and you are in your closet, which I think is funny.
Yeah.
So it's a good thing it's not a video.
Professional podcast studio.
There you go. Well, thanks for sitting in for Nicole. Got big shoes to fill. So this month, before we get to the listener questions, we're dealing with behavioral finance and cognitive biases. And you are an investment expert. I know that it's a weird word to hear, but you are. You think about this stuff, and you've dealt with a lot of committees and managing your own wealth and things like that. What cognitive bias stands out in all your work in the investment world that people struggle with?
Loss aversion. People, they don't believe that a loss isn't real unless they actually sell the asset. And they will hold on to assets for years because if they don't sell it, it's not a loss. And I always have come from an institutional money management perspective where we reported returns, realized gains, unrealized gains. If the count was down, we lost money. So there is no distinction. So it's important that if it's not a right investment for your portfolio, even if it's underwater, it's okay to sell it because it's still a loss, whether you sell it or not.
Yeah. I mean, it's essentially you have to have a very short memory about an ownership of the past, right? You can't get caught up in it.
Right. Which is the other thing. We regret too. I mean, we regret our mistakes. Viscerally, we feel that, and we have to overcome that also.
So loss aversion, essentially what you have to do is say, I have so many beans. I can't worry about how many beans I had yesterday, or dollars in this sense. I have to decide, how do I allocate these dollars in my best interest today? Rather than, right?
Rather than hold on to a bean because it lost money and you think it might come back, which is fine if it's the right bean for your portfolio. But if it's not, then you should get rid of it, even if you lost money on it.
Yeah, because you only just have the bean that you have.
Right. But people don't. They'll just keep holding on to that, hoping that it'll turn around.
Yeah. I remember a scene from, you remember the movie We Were Soldiers? Did you ever see that? No. It was about the first conflict in Vietnam. It was a Mel Gibson movie. And they're getting overrun by the enemy. And so they're calling in airstrikes to try to push the enemy off. And they call in an airstrike and it comes in way too close. And they see it as it's happening. And the scene is the lead, Mel Gibson, the commander, and then the radio guy, the young private calling in the coordinates. And it comes in and it's very clear that this is going to come on their own people before it. And they're just sitting there. It comes in, the horrible thing happens. And there's this hush where the young private is locked eyes with the commander. And the private just has this look on his face. Both of them like, oh my goodness. And the sound stops. And all of a sudden, all the sound of the battle comes into play. And the commander's like, okay, son, you just got to forget about that one. What can we do next? And that's sort of what you're talking about, right? Is like, you just go,
all right. Yeah.
What do you do next? Doesn't matter where it was.
Exactly.
That's a horrible picture to talk about.
Great story, but yeah, I mean, that's essentially it.
Yeah. Okay. Well, let's get to some listener questions. So we have Wendy, and this is a question, David, that we get often. She's a teacher and she's about to retire and she's deciding whether to take a lump sum and a lower monthly payment or just a higher monthly payment. And there's no COLA adjustment. If she takes a lump sum, it's pre-tax money. And she's worried about the pension fund because the state, as many states are, is a little underfunded. And she's wondering what to consider. That's a common question. Do I take a bird in the hand or do I take these payments over my lifetime? I have some thoughts, but I'm curious. Do you have any thoughts of what you should consider in that decision?
For sure. I think foremost, how much is the lump sum? Let's say it's $100,000. And how much is the reduction in the annual pension payment? So if, let's say the pension was going to be reduced by $6,000 a year and the lump sum's $100,000, you divide the $6,000 into $100,000 and that's 6%, which is basically the break-even rate that if you invest that $100,000, you need to earn at least 6% a year to make up what you lost in the pension. So if the pension was only going to be reduced by $3,000 a year, then you only need to earn 3%. So that's sort of just the basic math of it. But then you have to weigh that against the potential for in this case, the state of Pennsylvania, to cut pension payments. And I happened to do an episode on this back in episode 269 last year on public sector pension crisis. And Pennsylvania is about 60% underfunded their expectation. Even if their returns fall a couple percent below their expectations, it'll be 80% funded in the next 10 to 20 years. And it's also a state where the hurdle to cut pensions is pretty high from a legal standpoint.
Okay, so you have the protection from a legal standpoint, but that the money side of it doesn't look that favorable from a fundedness standpoint.
Well, I mean, pensions could be underfunded for years. The question is, they didn't cut the benefits. And Pennsylvania is one where they use contract law, where effectively these were promised benefits. From a legal standpoint, the hurdle's pretty high to decide whether they can cut those benefits that have already been earned. And they can cut future payouts for people that are still accruing it. But if you're retiring, those benefits, seem pretty secure, and they're for life. And that's the other consideration. This is essentially guaranteed or pretty guaranteed lifetime income. And so generally, it's probably better to take the pension unless the lump sum payment is just huge. And so the hurdle rate, what you have to earn investing that, is not very high to offset how much you would have got with the higher pension payment.
Yeah, and typically that's where you start. Exactly what you said, right? What is my payout relative to the lump sum that I'm being offered here? And most of the time when I look at that, the pension makes sense to take the monthly payment, because trying to recreate that, whether it's through an annuity or investing, has all, one on the annuity side, generally you cannot recreate that same payment. And then if you're investing it, well, you just opened up a whole nother bag of goods.
You're not. Yeah. Right. Because annuities, it's based on, that's an insurance company investing basically at bond yields, whereas the expected return for the Pennsylvania pension system is 7%. I mean, that's what they're targeting. That's what they've achieved over the past 20 years. And as a result, they can make higher pension payouts versus perhaps a annuity.
Yeah. And another factor that I think comes in here, Wendy, is longevity. You didn't say how old you were, but if I've had clients that were 65, have had major heart surgeries or other genetic things that have really impaired their potential longevity. Whereas, so if you take the pension payment, and I'm just going to assume in this discussion that it's you only, well, that pension payment goes away when you pass. And you have other options if you have a spouse involved. Well, if you have a life expectancy of realistically 10 or 15 years, and I've dealt with people that have had those kind of life expectancies, now the payout ratio changes a little bit because you're not really trying to plan to live to 95. Then that would be something to consider. The lower your life expectancy, the more it starts to tilt towards taking the lump sum. How much it has to be down before you tilt, I don't know, but in your situation, but I think that's something to consider. And then the other part, I think, is what your goals are. Some people, even if the payout ratio is right, they have other assets outside of, they don't need the guaranteed payments, I guess is the point. They have ample assets outside of the pension benefit that they choose. They prefer to have the money in order to invest because really it's multi-generational money and most likely it's going to go to someone else. That might lean towards taking the lump sum. But I'd agree with you, David. I think vast majority of time, the pension makes the most sense from the financial end of it. So let's go to our next question, David. And this is all you, buddy. This is Linda on rebalancing. She says, hi, Roger and Nicole. You're Nicole today, David. I have a question about rebalancing. I am interested in your perspective. I recently transitioned to being a DIY investor. My plan was to rebalance twice a year in July and January. Due to all the market fluctuations recently, should I stick to this plan or rebalance now? Or is twice a year enough with all this volatility? Do you have any thoughts on how this volatility plays into rebalancing programs?
Well, it depends on the particular rule that they're following. There's two ways to go about rebalancing. One is what's known as a calendar approach. So on a specific date, you rebalance twice a year, once a year. And this isn't just individuals, institutional university endowments do the same thing. That's one way. The other is a threshold. If the portfolio, let's say you have a target in large company stocks, if it's 10% underweight that. So there's a specific threshold. And then if it's a threshold, then the second decision is how frequently do you look to see if that threshold has been breached? Do you look once a month, once a quarter? In this case, you're almost doing two. You have a calendar approach, but you're also kind of looking at it before the date and looking at threshold and saying, well, my stocks might be underweight. The best paper I've seen on this was a paper titled Best Practices of Portfolio Rebalancing by this Vanguard. The authors were Zilbering, Giaconetti, and Kinnery. And they looked at all different permutations and essentially concluded that the risk-adjusted returns just didn't change meaningfully whether you rebalance monthly, quarterly, annually, or threshold. It's just their conclusion is have a plan and stick to it. Because if you start doing more and more rebalancing, then you have to figure out what the cost of that is. Now, we're in an environment where trading costs are much lower. So that's really from a rebalancing standpoint, but the underlying assumption, you actually have a target. My approach to investing, I don't have a target. So I don't believe there's an optimized allocation. And so I'm willing to make adjustments as things change.
And that's not really rebalancing, that's changing allocations based on some matrix of valuations and so forth. It's not
right. I'd call it an asset garden approach. So rebalancing assumes there's an optimized target. And as humans, we don't optimize, we cope. And so I just want a diverse garden. And if I want to prune some asset because I think that it doesn't serve me as well anymore. And so it's a completely different approach. And one isn't better than the other. I think the simplest is to have a target and to rebalance on a periodic calendar basis. And it takes a lot less stress because then you can just ignore it. It's like it's June 30th, time to rebalance, and then you rebalance.
Yeah, the most extensive paper I read, and this was years ago, basically concluded the same thing. Was
probably the same paper.
Yeah, this was a while ago, but it was once a year is enough. There's not much utility in overcomplicating it. And even in trading costs are at zero, but you have the other cost of maybe tax consequences, but also you just have the hassle cost, which is, right? And the thing that I think that you said is most important is like you have a garden approach. You don't have a hard asset allocation approach, but whatever your approach is, have a approach or process, meaning singular, where we tie ourselves into knots is we have a approach and then markets tumble and we're like, well, maybe we should have that approach. And then we switch back. Right. And then you really don't have any approach or process.
No.
Yeah. Well said. So hopefully that helps. I think we overthink this too much sometimes.
Oh, we do. And that was part of the conclusion. The returns didn't change that much, as they kind of did their back test, irrespective of the process used. It's all pretty similar. So choose one and stick with it.
So our next question our last question is from John, and it's related to taxes and a home sale. So before we get to the question, David, I have a question for you.
Sure.
What is your view on paying taxes?
Well, from an investment standpoint, and I get to ask this a lot, if you owe taxes as an investor, that means you were a successful investor because you generated gains. And sometimes, even in the case of a house, right? He's concerned the house went up in value, I owe taxes. Well, that means you had a successful home investment. And that's just part of it. So I have no problem. I think it's fine to minimize taxes as much as possible, but you can't avoid them because that's part of being a successful investor. It's paying taxes.
So when we talk about minimizing taxes, do you have a view of where the diminishing return is on how much we twist ourselves into a pretzel in order to minimize taxes? I mean, there are obvious things that you can do, right? You can tax loss harvest to offset gains. You can do 1031 exchanges with a house to a house if it's an investment property. I guess everybody has to draw a line of how far they're willing to go from a tax strategy standpoint.
Right. You can own municipal bonds right. I don't spend that much time worrying about taxes. Now, if you own index funds or ETFs, they're pretty low tax burden. You try to keep the investments that might have higher dividend yields or more income and tax deferred accounts. But I mean, it's just part of investing. And so
it's part of life.
Right.
Yeah. I mean, so John, his situation is basically he has a home and they're selling it and he has about $1 million capital gain for his home. And he wants to know what he can do to lower his tax burden on the capital gains that he'll have to pay on the sale, that $1 million, because that's going to be taxed at capital gain rates. And in his question, he points out, if you're married, if you fit certain parameters, it's your primary residence, you've owned it for more than 2 years, and you've not used this exemption in the prior 2 years before the sale, as a married couple, you can exempt $500,000 the profit on a primary home sale. So his $1 million of capital gains of this great home investment, as you said, David, that's already off the table. He's not going to pay taxes on that. That's huge. So now he has another $500,000 that he's going to have to pay taxes on. And so how do you possibly reduce? So there's a couple things. One is, and I don't think this one's going to apply for you, John, that is there is an exemption for work, health, or unforeseeable events. It's IRS publication 512. Maybe you qualify in some odd way there. The other way is to look at any home improvements you've done over the years in the house. And that's something a lot of us forget, right? I mean, we're putting in a little backyard thing right now in our home. That's a cost. It costs money, more money than I wish. That adds to my cost basis. So usually when we're selling a home, we just think of, I bought it at X, I'm selling it for Y. And the difference is my gain. Well, if you put in a pool, you put in a really nice shed or backyard kitchen, all of those things increase your cost basis, which might help you decrease your tax burden at some point. So those are some very practical things. But congrats. We don't have that kind of home appreciation in Texas as they do in California.
Well, and what's nice is they changed the law. I mean, it used to be you could roll over the house and not pay taxes, but you had to be a more expensive house. And so you had these people moving from the East Coast down to Texas and have to buy these huge mansions because the price differences in the house in order to not pay taxes. So
yeah,
we have way more flexibility to buy a house the size fits our lifestyle as opposed to a house dictated by the tax law.
Yeah, and John lives in California, and this is the reason I was wondering your perspective on taxes in general. He lives in California, and he puts in his note that some have said that establishing a domicile in Nevada will allow us not to pay tax in California on the gain, because he does have the extra tax because of California. I don't know about that rule, and I don't know if you ever want to live in Nevada, but that's where you'll have to draw the line of really researching. It's easy to make decisions, letting the tax drive the decisions that can create lots of unintended consequences. I'm more in the view of you, David, of I'm okay paying taxes as long as I can minimize what I can minimize.
Right.
So hopefully that's a little helpful, John. What's going on in your world, David?
I just keep doing my podcast, Money for the Rest of Us, serving my community.
So it's Money for the Rest of Us podcast, which is huge, and it's really thoughtful because you're a thoughtful guy, and you have a book by the same name.
Right.
And we've had you on the show talking about the book, and you have a community. Is it by the same name?
Yeah. Well, it's called Money for the Rest of Us Plus, right? That's the name of the community. You are a
creative guy. You keep it simple. I like that.
And, the only other thing I'm doing is we're trying to survive a pandemic.
Oh, yeah. And there's that.
And global economic depression.
Unfortunately, David Stein lost power in his house. So we're going to leave it there with David and go set a smart sprint.
On your marks, get set.
And we're off to set a 7-day goal to take a little baby step to, create a great life. So in the next 7 days, I'm actually going to suggest you spend some money. I'm going to suggest that you purchase Daniel Crosby's The Behavioral Investor. It's an amazing book. He also has a great book called The Laws of Wealth. And I have no dog in this hunt, as I say, but it's a really good book that will help you start to explore this idea of making decisions as a semi-rational person. And you can feel there are a lot of great articles online too, but this has been a go-to resource, these 2 books. And he's a super smart guy and very nice. So next week we have Benjamin Brandt from Retirement Starts Today podcast joining us to answer some of your questions. So appreciate you. I'm very lonely. I'm bringing all my other friends in, but I miss Nicole already. I don't know what I'm going to do for 2 months, but I know what you're going to do. You're going to have, hopefully, a great summer. Talk to you next week. Hey, it's time for that all-important disclaimer. We so appreciate you listening to the show and love your questions and love the teaching that we're able to provide here. And actually, it helps us too. But remember, you're not our clients.
Not love it if you took advice from us on the show.
We would not love it if you took advice from us on the show. Realize this is helpful in education. Talk to your legal advisor, your tax advisor, or your financial advisor before you make any decisions.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.